So, trading for a living can be one of the most important things we do. It can change our lives, it can change the lives of our families. There really isn't anything that isn't cured by being able to trade for a living. You want some free time, you want big money, you want to quit your job, more time for family and friends. I mean, trading for a living well done pretty much is the answer, right? But there's a dark side to trading for a living. There's a dark side that we don't like to talk about at parties, Colonel Jessup. And that's what we're going to talk about in this month's video. Now, we're going to go over a few numbers. This is not financial advice. Do not risk any money you cannot afford to lose, and so forth. But there's something we need to talk about because it's not like we should change our goal. It's not like we should not try to trade for a living or invest for a living. For example, if you're a FIRE, financial independence, retire early. Anyone who's using the market / trading is got to come to grips with this dark side. And the dark side is, as this poor fellow on the screen is showing us, what happens when the market goes down? Yikes, right? What happens when we decide to, okay, we'll use our 60-40 bond stock mix. We'll retire because we're ready. We're going to pull 4% out, and then the market tanks. Wait, the market never tanks. Oh, wait, that was so 2021, right? We're in a bear market as we sit here in July 2022. And if you needed money in 2022, there's a big problem, right? Trillions have been lost so far in 2022 in retirement accounts. I'm not making that up. Over 8 trillion. So that's the dark side. What the heck do we do about that? Because these bills, they keep coming in. We still have rent. We still have mortgage. We still have expenses. We still have everything that needs to be paid. Oh, food, right? How do I pay my bills if I didn't make any money that month? Trading for a living is not like a job. Financial independence and retiring early is not like a typical job, right? Because money is not guaranteed to come in. If you trade for a living, day trading, anything, what if it's a bad month, right? So here's the dark side. How do we make money come into our lives when our systems lose? Because guess what? Everybody loses. Everybody loses trades. There are always losing months, and there are always losing years. Always. Well, how could I quit my job if there's going to be months where I don't make money? So here's the question. What makes money come in to our bank account every month, right? If we're going to be a trader and we can't deal with the losing, right? And who really wants to deal with taking money out and seeing our accounts go down? So what the heck can we do? Is this the most important question? Is this the question that we need to answer? Well, we could invest in Bitcoin, and I'm sorry, that's kind of a joke. I don't do that. Or we could get a job, right? I'm going to say it now, but understand I'm never saying it again. So get used to it. I'm never going to say the word side hustle ever again. I think it should be banned. But anyway, you could get another job. Better way to put that. But then we're right back where we started, right? We're working instead of trading / FIRE investing for a living. Here we go. Now we're getting better. We could buy and rent properties, right? Buy a duplex, buy a house, buy an investment home, buy an investment apartment, something, and rent it out. Now, does this bring money in every month? Yes and no, right? Now, I have very good friends who do this, and it can work just fine. Don't get me wrong. I'm not saying don't do it, but you have to find the price. You have to find a price you can afford in the hottest real estate market we've seen since 2008, right? We now have mortgage rates, going up, and mortgages too, for that matter, right? Finding a place is super hard. Can be done, of course, can be done. Then you have to either buy it with debt or pay for it with cash. Well, if I had all this cash, why am I, there's a problem. Why don't I put that into a trading account or do something else with it? But let's say you even had cash. All right. The easiest way, you pay cash for it, and then what? Now you have to find tenants. Well, what if you don't? Well, what if we go through a recession? What if you, do you see the problems? And I could go on, but this is not the problems with real estate video. This will solve the problem, but there are huge obstacles that we must go through to get to this problem solved, right? At least to solve it this way. Well, here's the secret weapon and the title of the video. What if we did something like this? Okay. Horizon's NASDAQ 100 covered call ETF, aka QYLD. And just saying that makes people crazy because QYLD is a very popular slash, well, I don't want to say cultish, but very intense liking and opinions about QYLD. What is it? It's an ETF. Great. What does it do? It pays a 15% dividend right now. Again, this is July 2022. Wait a second. What? Oh, how do I get that? Do I have to buy a house? Do I have to get a more? No. You click a button. Click. I'm trying to click that. It's just a screenshot. And you hold it, and you get 15%. Well, when do I get that? Every month. What? Every month. This is a monthly payout ETF. It pays a double-digit dividend every month. Now, there are some videos on YouTube that love to talk about QYLD, and if you want me to give my take on it, I'd be more than happy to do that. But for the purpose of this video, let's just consider that this is something we might consider. If it pays out that dividend, and granted, it's less than 15% after the expense ratio and after we take taxes out of our dividend, but we're still looking at double digits, right? 10 or above, 10% or above. Wait a second. When do dividends come in again? Monthly. Every month? Every month. Money coming in every month. Whoa. Horse, right? That's crazy, right? Why aren't we thinking about that as traders or as system developers? Why aren't we considering the fact that we have a vehicle that can bring money in every month? Now, wait a second, of course. If we're talking about dividends, isn't this dividend? Because guess what? This is what I thought dividend was. I've looked at dividends for 14 seconds in the previous several years. And this is what I always thought dividends turned out to be. 2.41%. Nice. 2.41%. That's wonderful. That's less than inflation. That's a savings account from the old days. Like, really? That's my life? And I have to save up $42 million to make $10 a month? Grossly exaggerated. Remember, a disclaimer. But the point is that you would need $1 million or $2 million to get Johnson & Johnson to be your vehicle to retire. If J&J was all you had and you needed $100,000 a year, well, we could do the math, but you see where I'm going with that. You need a ton of money to make a little bit of a payout, right? And that's what I thought of. So why would I ever do that? Because that's what I thought dividends were. Why would I ever worry about this when a trading system does so much better, right? But let's think about it this way. Now, dividends on the whole, again, we can talk more about dividends if you want. There's dividend growth, which people are very passionate about. And this is a long-term buy and hold, and you buy something with a 2 to 4% yield, higher if you can get it, but probably not, that grows its dividend 5 to 10% a year, and you put $1,000 a month in it, and you keep buying, and you reinvest all the dividends, and 30 to 40 years from now, you have a lot of money. And that's great. No doubt about it. That's fantastic. If you have 30 to 40 years to let this compound, that works magnificently. Right? Now, the key to this is you have to buy low yields. So that doesn't make sense. Why have to buy? Because low yields are safe. And this is a 30 to 40 year strategy. So we need to make sure it doesn't go kaput. So we buy low yields like J&J, but it will be safe. And then we just let time fly. It's the snowball effect, right? It starts small, and then at the 10-year mark, you see a little progress. At the 20-year mark, you're like, oh, this isn't bad. And at 30 years, you would have something really nice, okay? But it takes literally decades. So that's really the two camps, right? You have traders, you have index funders, and you have people who believe in dividends. That's not two camps, but anyway. But what if we didn't need the dividend to grow? What if we thought about this completely differently, like Steve Jobs in 1984? What if we didn't need our stock or our instrument to be a dividend aristocrat? You know what those are? They pay out dividends for 25 years in a row, right? They increase their dividends, for 25 years in a row. Or what if we didn't need our dividend instrument to be the bedrock of our 4 to 8% per year, right? Because that's what we want out of stocks, 4 to 8%. Sometimes we get 10% if we get in a magic bull market like we've had up until 2022, okay? What if we didn't need any of that? What if we only need something to fill the gap? We already have our trading. We already have something else. We don't need dividends to be fuddy-duddies for 30 to 40 years, right? We don't need that because we're traders. Well, what do I mean? Here's a video on my YouTube channel. It's the name of it. It's under the education playlist, Creating a Portfolio with One Indicator. This is what it looks like when I talk about the system that I'm going to talk about right now. It is in Forex. It's a long-term system. It trades on the 4-hour chart using a Bollinger Band breakout, okay? And you can get all the details on this video at the 20-minute mark, okay? What would this system hypothetically produce? Again, remember the disclaimer. Trading one lot in Forex, one lot every time, no compounding on a sample, I don't know, $20,000 account, let's say. It could be anything. Could be 10, could be 50, could be 100, could be anything. Let's say 20-ish, okay? This produces, from a $20,000 hypothetical account, $101,000 of profit. Drawdown is about 23%. That is way, way, way less than the market, by the way. Way, way less than even dividend stocks, which tend to do better when the market gets bad, okay? Wow. I don't need 2.41% dividend to grow over time. I've got this, okay? Now, the thing about dividends is, how do we get the snowball? Do you remember? You have to reinvest all your dividends and you have to add money to your account. That is compounding on compounding. That's how you get to the big numbers. Well, this is no compounding. Still looks pretty decent, right? This is if you compounding. How would you compound? Well, every time you get a winner, then you increase your trade size. If you get a loser, you decrease your trade size, or you build a robot like I have that does it for you. So from 2003, August 2003, same here, August 2003 to July 2022, same date range. If you compounded, starting with one lot, you would have $1.2 million of hypothetical money. Drawdown is now in line with index funds, but remember, you would get this drawdown after you'd made a boatload of money, and boats can carry a lot of money, right? That's a big drawdown, $200,000 drawdown, but guess what? You already have probably $1 million or so, right? At that point in the equity curve. So $20,000 of hypothetical money just turned into 1.2 million. Got that? Understand what we're talking about? Not 2.41% dividend, okay? Index funds and dividend snowballs, can't touch that, right? Doom, 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 doom. So let's have some numbers. A dividend stock like J&J, everybody loves J&J. If you did everything you're supposed to do and reinvested all your dividends, right? We didn't add money this time. We just reinvested our dividends. $20,000 turns into $171K in 20 years. Great. That's great. Very safe, right? Awesome. The trading system we just talked about grew 20,000 to hypothetical 1 million. Is 1 million better than 171? It is. But what about the lean times? Okay. Now let's forget the dividend, or I'm sorry, let's forget the compounding for a moment. But let's just say we didn't compound, right? To make apples to apples, for example. 15% dividend on $20,000 stock is about $3,000 per year, right? If you do the math, 15% per year on 20 gives $3,000 per year, or $250 a month, right? Not bad. If we go back to our fund up here without the compounding, do you know what the biggest losing year is? There's a couple of losing years, and you can see all the results in the video, but they were less than $3,000. Interesting, yes? What does that mean? Assuming no compounding, right? If we just traded it using a dividend stock that pays an outrageous 15% dividend like QYLD, that would make money come in when the trading system had a losing year. In other words, that dividend turns every losing year of this particular system into a winner except for 2006, and then it was a very small loss, right? So we use the dividend to fill in the gaps when the system loses, right? Now, we could, since we're going for it in our trading account, we could save up our money and use a bigger quote-unquote safety account, meaning not $20,000 of dividends, maybe 50, maybe 100, because we only need that to fill in the gaps. We don't need it to make money or grow or snowball. We don't need that. Our snowball is here. We don't need it to snowball, right? Just another way of thinking. We could have the power of a trading system with income backup. And I guaranteed in quotes because nothing's guaranteed, but a dividend that is paid out and the stock or the instrument doesn't go to zero, that is about as guaranteed as not guaranteed gets, right? Again, what if we don't care about share growth? We already have all the growth we need. We don't need anything else. Interesting, right? It's very, very thought-provoking and something I've been thinking about quite a bit. Now, we're going to finish the video with a little bit of speed round. First up, I'm never going to give you any homework, all right? In my professional career as a tennis teacher, I never made my students pick up balls, right? You come to play tennis. You don't come to pick up balls, right? I'm not going to make you do homework in my videos. I'm not going to interrupt you and try to get you to click buttons or do things for me, okay? I'm not trying to build a brand here. I'm trying to talk to you and give you uninterrupted information that hopefully is helpful, okay? So keep that in mind. I'm never, ever going to make you do homework in my videos. And if you want to talk more about dividends, though, feel free to let me know. I wrote this book last year. It's got a couple different trading systems in them that happen to be doing pretty well hypothetically today, okay? And if you want more systems like the one we talked about, go to scottwelshstrategies.com, performance page, and you'll see stuff like this. I give equity curves and results for other systems that are similar to the one we've talked about in this video, okay? What if we use dividends with our trading system? Fascinating, something to think about, and maybe we'll talk about it more in a future video. That's all for this month. We'll talk to you soon. Bye for now.